Hello, this is Brian Rezny, president of Rezny Wealth Management, and of course the host of the Rezny Wealth Report every Sunday, or excuse me, every Wednesday on TV Live at 6 p.m. We have a rebroadcast on Sunday if you miss any part of today's show or you want to watch it again. That's Sunday nights at 7:30. By the way, on Sunday morning from 10 a.m. to noon Eastern Time, we will have a live radio show that broadcasts throughout Florida. Go to my website, reznywealth.com. You can check out available stations within our area, and you can also look at the times that we broadcast. We also will have rebroadcast of this show actually on our website itself in the Media Center. So it's a great chance to get a great education about your portfolio. So if you have a question today about a stock or a bond, I will be turning on the phone lines in just a second. We're taking calls from you, the listener, about your retirement portfolio. Maybe you own an investment you're not sure about. Maybe you're questioning the advice. You're starting to realize after listening to my show for some time, there's real advisors and there's a lot of pretend advisors out there that sell investment products. And unfortunately, those salespeople's interests often are not the same as yours. You want to make sure you protect that retirement, and the first way to protect it is make sure, obviously, who you entrust with your money. Our phone lines are open, 239-417-4711. I'm taking your calls live, or if you'd rather, you can still call that same number, give your question to a studio producer, and I'll take your question off air. You know, the market basically has hit pretty much a new high. The S&P, and basically the Dow. And this happened yesterday, and today was another little up day again. I think a lot of investors have missed the rally in the equity-based markets, but more importantly, I fully believe that a lot of investors are really on the wrong side of the fence, period, with their portfolio. I think I've seen too many investors load up on bond or bond-type investments, whether it's individual bonds or bond funds. And ultimately, I believe over the next 3, 5, and 10 years, investors in traditional-based fixed income bonds and bond mutual funds are greatly going to underperform or make very little return on their money. I think there's just too many investors out there that think that bonds are a safe investment, and unfortunately in today's low interest rate environment they actually have more risk to the downside. If rates either stay stable and slowly move up, you could see an erosion of your capital base. Not to mention the interest rate that you're seeing on these long-term bonds, intermediate or short-term bonds, are the lowest pretty much in history. This is going to have a bad effect on retirees who need income, especially if you consider taxes and if you consider inflation. Again, I think investors need to realize that you need to make changes to that portfolio when necessary, following a detailed investment strategy. By the way, this afternoon I did about a 2-hour-long workshop, not a free lunch seminar, folks. We don't do those. We do educational workshops where we teach you, the retiree or pre-retiree, what you've never been taught before. The topic of my workshop was called Adapt or Fail. And let me tell you what, the people that left this workshop gave us incredible testimonials about how much they learned at this workshop and how different this was than anything else they've ever been to. We talked specifically about the 3 biggest risks to their investment portfolio, how to adapt and succeed with your retirement portfolio in any economic scenario or any market. We talked about specific investment strategies that are well defined that help protect the downside in a retirement portfolio. People left this workshop basically educated on what they should be doing. Because of the success of this workshop, we're actually going to have another one in Fort Myers on Wednesday, March 27th at 11 a.m. If you'd like to attend this upcoming workshop, there is a cost to attend. Go to my website. We have very limited seating now. It's almost sold out. Go to reznywealth.com, and you will see on the right side of the homepage, workshop setup, so that you can sign up for our workshop and you can actually attend and learn what these same people today learned. I want to talk a little bit about what we're seeing out there in the economy. First off, job numbers today, not bad at all. This has been what I call a stealth rally in a lot of different sectors, not just the U.S., but in other broad sectors around the world. What we're seeing is a slowly improving economy. Nobody wants to believe it. I think investors overloaded the boat, got out of equities or equity-based investments at the low of the market, or were very light in that allocation over the last 4 years and missed a lot of return in their portfolio. I think now they're looking at what do we do now with our bond portfolio? Do we hang on to what we have, or is it time to sell? The number one call that I have received on my radio shows over the last 6 months has been about Apple Computer. When I talked about adapt and fail, what I mean by that, folks, is simple. You need to know when to sell an investment. You need to know when to adapt or when to change that portfolio. Buying and holding any investment through thick and thin is not an investment strategy and often will lead to mediocre results. I want to bring up a quick chart on Apple Computer. This is a chart, and what I want you to look at here is the 35-day moving average, the 100-day moving average, and then the 200-day moving average. You can clearly see around October, November of last year, Apple started to roll over, and it breached important key technical indicators. That would be the 200-day moving average. A lot of investors will tell me, Brian, I buy stocks. I'm a long-term investor. You could be a long-term investor, but if you don't sell those stocks before they go to zero, you're not going to make a dime in return. How many of you have ever bought a stock or were sold a stock? You bought it at the top, you watched it drop 20, 30%, you said you were going to hang on, wait till it came back, and it never came back, and it kept going down and down and down. One of the number one indicators that I love to teach investors at my workshops is how to use charts or moving averages in order to protect your portfolio from major risk, like Apple Computer. Since Apple's been the number one stock that I've received a lot of questions on, I thought I'd show you that chart. I think the biggest risk that you, the investor, have, though, with your portfolio is really not having an investment strategy at all. But I'm taking your calls. If you have a question about a stock, a bond, a mutual fund, maybe you want to understand how ETFs work and how I believe they're better for your portfolio. Maybe you went to one of those free lunch seminars and somebody loaded your portfolio with a bunch of variable annuities or annuities, and you're realizing that wasn't the smartest thing I ever did, and you want to know how to get out of those or if you should even keep them. Before you buy your next investment, this show is all about you, the listener. 239-417-4711. I'm taking your calls live, or you can call that same number, relay your question to one of my studio producers, and I'll take your question off air. Don't underestimate the drag of bad investment behavior. Let me tell you what I mean by this. Delbar is an independent company that basically looks at investor returns and investment returns. What happens is so many investors fail to beat the markets, have substantially lesser returns than even investments that they own because they constantly buy and sell or they buy and hold. They don't have any investment strategy. Too often what I find from investors is this: because you lack an investment strategy that is actually disciplined, written, and followed, you, the investor, is ultimately shooting from the hip. You're sold investments from that so-called advisor. There's really no investment strategy, so because you didn't know what you should really buy and you were given a recommendation by that Wall Street firm, but you didn't know when to sell, ultimately everything that is bought may eventually need to be sold. Stick with your investment strategy, which must include risk management. I talked about this a lot today in the workshop that I put on in Fort Myers, and I think people, the attendees, were completely blown away. Not one of those people in the room came up to me and said, Brian, I have an investment strategy in writing, or my so-called advisor does. What I told these individuals and what I tried to teach them over that 2-hour workshop is if you don't have an investment strategy in writing, the best you can hope for is mediocre returns and more risk in your portfolio. It's kind of like baking a cake. Would you bake a cake or any recipe in the kitchen without a recipe card? So how can you actually invest your hard-earned dollars in something if you don't know how that fits into your investment strategy? When do you buy? What do you buy? More importantly, when do you sell? I can remember getting so many phone calls after the 2008 market correction that lasted 15 months. By the way, the S&P dropped 55% from top to bottom. Investors like you were devastated. Did you ever get a phone call that you should sell? That's why I try to teach investors, look at moving averages. Decisively, that 200-day moving average triggered on the S&P to sell sometime around January of 2008, before the major carnage occurred and before investors like you lost a lot of their money. I've got a caller, you're on the line. What's your question? Peter?
Yes, hi, how are you?
I'm excellent. What's your question?
Well, what it is I've discovered something that a lot of people aren't talking about, and it's silver.
Okay.
And
what's your question about silver, Peter?
well, I want to know what you know about silver, because I'm finding out that a lot of financial people are not mentioning it on the national media. Most of it's on YouTube.
Okay.
A lot of the information.
I'll tell you what, Peter, if you get a chance, I'm going to put you on hold because I got other callers coming in, so I'm going to answer you on the TV, so I'm going to let you go there. I talk about silver actually quite a bit on my radio show, and what I tell investors is stay away from silver unless you're a short-term trader. Silver is way too volatile for the average investor. The average investor isn't a short-term trader, meaning week by week or month by month. Most investors are not technical traders, investors. If you're going to buy silver, that is a whole different realm. It's a very highly volatile investment. And at the end of the day, you can buy silver, Peter, but you better make sure you understand how the technicals work, and you have to have very defined buy and sell criteria when you look at silver. I would personally never buy silver for one of our client portfolios. I would rather use gold. It's less volatile, and it reacts better when we're buying it for particular economic scenarios, and it also fits very well in long and short-term trends when we look at a relative strength ranking. So while you can buy silver, I don't recommend any of my listeners buy silver unless you're a short-term trader. You'll like a lot of volatility and, more important, a lot of risk. I've got to take a quick commercial break. I'll be right back with your calls, your questions after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. And we're back. You're listening to today's program. Of course, it's Wednesday. We had a great workshop today. We had a number of attendees there that learned things they never learned before. What I always tell investors that attend any of my workshops, first off, these are not free lunch seminars. These are tell-all type workshops that really teach you, the retire and pre-retire, how to not get bamboozled with your money, how to find a real investment strategy that can help you build wealth and income for your retirement. I think too many investors, the first thing they ask is, what about this stock or this bond? The first thing you should be asking is, how do I develop a sound investment strategy so that I can help reduce risk and potentially increase returns? Let me talk about the biggest risk that you as the investor have. Not having an investment strategy, and more important, not following one once you develop it. I can tell you, out of all the attendees at my workshop today, not one of them actually had an investment strategy in writing. They pretty much all told me, you know what? A lot of the stuff you taught today, Brian, is exactly why I haven't made money, or I've lost a lot, or have done very mediocre. I had a lot of comments like that from our attendees today. The bottom line is this, folks. You don't bake a recipe in the kitchen without a recipe card, and you can't start investing your hard-earned retirement money and expecting any quality results without an investment strategy. So ask yourself and be honest. Do you or your advisor have an investment strategy that is religiously being followed, and can you pull it out and produce it? If you can't, that's the number one crux of your problem, is not having a strategy and not following it. If you have questions about your portfolio, I'm taking your calls live like my last caller, or you can call that same number and I'll take your question off air. That's fine at 239-417-4711. Please visit my website if you want to find out more about our upcoming workshops, or if you'd like to call my office for a consultation. As I always tell our investors, there's a substantial difference between how Rezny Wealth manages portfolios other than Wall Street. Call our office. You'll be happy you did. Schedule a consultation at our Naples or Fort Myers office. We would like to talk to you during the week and help you achieve your financial goals. I want to go to my first off-air call. This one's from John in Fort Myers. I'm recently retired and I have a 401k plan. What do you recommend? John, we get a lot of new clients that have 401k plans or qualified plans when they leave an employer. This is what I always tell all investors. If you are working for a company, most often the money has to stay inside that qualified plan or 401k plan when you're working. Once you retire or you leave that employer, I always recommend taking that money and rolling it into a self-directed IRA. You do what's called a trustee-to-trustee transfer. By doing that, you have really unlimited quality options now you can pick from, John. In your 401k plan, you're limited at best. The average 401k plan that we've reviewed has 10 to 15 to 20 investment options. A lot of them are just kind of so-so, and a lot of them are pretty much all correlated or very similar, meaning a lot of U.S. equity funds or a lot of bond funds. It misses all the other asset classes around the world. So by moving the money from your employer into an IRA account, John, you now have the vast universe of investing opportunities instead of just stocks and bonds or stock and bond mutual funds in the U.S. I would seriously roll it over to an IRA. We do a lot of 401k plan rollovers, and we manage a lot of qualified dollars like that. You can always call our office during the week for a consultation. I'll put our number at the bottom of the screen that you can call, and you can also visit my website for more information about our firm at reznywealth.com. Again, that's reznywealth.com. By the way, when you do go to our website, we offer a free weekly newsletter around retirement and investing and what you should and should not do with your money. It's a nice, easy read. It comes at Every Money via email, and that's the best overall landscape of what we see in the economy. We do it every week in our newsletter. We talk about what not to do, and I think it's important that investors understand not only what you should do, but how to avoid the big potholes and the bad advice too often that especially retirees seem to be the brunt of. If you have a question about your portfolio, 239-417-4711. I want to go to another call. This one is Ed in Fort Myers. What do I think about emerging markets? Do I have any suggestions? Great question, Ed. We actually like emerging markets a lot. Let me tell you my viewpoints first on emerging markets, and then I'll tell you what we actually own now and why we own it. First off, if I look at the emerging markets as a whole, they're growing faster than the U.S. and the other developed markets around the world. They're actually substantially cheaper on a PE ratio than the U.S. and other parts of the world. But what I want to tell you is this. There's different segments of emerging markets, whether it's small, mid, or large cap. Right now, mid and large cap emerging markets are actually trailing quite a bit and are relatively weak. Small cap emerging market is actually relatively strong. One of the things that I teach at my workshop is how to figure out what you want to be invested in based upon relative strength, a proven strategy that can help you really build a quality portfolio. So what's happening is this. We do own emerging markets now, but we only own small cap emerging markets. We actually own the Wisdom Tree DGS. This is small cap emerging market stocks that pay high dividends, around 3.5% to 4%. Now, again, our positions can change at any time. And again, fair disclosure, we own that position at Rezny Wealth Management in our managed accounts. We own small cap because small cap is greatly outperforming large cap, which is really lagging or down overall for the year. A lot of the large cap sectors across the spectrum in emerging markets are actually down for the year and are very weak. Never buy something going down, and stay away from relatively weak because it has a tendency to underperform. I do like, again, emerging markets, but we currently are in small cap, and I preface that right now, and small cap emerging market is towards the top of our relative strength ranking. I'm going to go to a quick little break here. I'm going to line up some more phone calls and questions. If you have a question about your portfolio, please call me right now at 239-417-4711. I'll take your call live, or if you'd like, you can call that same number and give your question to a studio producer, and I'll take your question off here, whatever's good for you. Also visit my website, reznywealth.com, and remember, folks, you either adapt or you fail. If you want to find out more about my upcoming workshop, it's a tell-all. It will teach you what you've never been taught about investing. Go to my website, reznywealth.com. I'll be right back with your calls and your questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risk to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. And we're back. Of course, it's Wednesday. Every Wednesday live, we're here to help you and educate you about your portfolio. If you have questions about your portfolio, whether it's about a stock, a bond, a mutual fund, maybe somebody sold you 4 or 5 annuities at some free lunch seminar, and you're realizing, again, not the best advice you ever got. If you want to understand the difference between a fee-only registered investment advisor and a pretend advisor or a salesperson, call me in the studio. We'll be more than happy to tell you why it's important to use a fee-only registered investment advisor, why these firms work in your legal best interest, and why most advisors actually work under the lesser suitability standard and don't have a legal obligation to work in your best interest. It's who you entrust with your money, we believe, that makes a difference. And if you have a firm that doesn't have an obligation to work in your best interest, what can you expect? If you have a question about your portfolio, 239-417-4711. I'm taking your calls live, or you can call that number, relay your question to a studio producer, and I'll take your question off air. I want to go to a quick stock before I go to my next call. And again, I talk a lot about individual stocks. We talk a lot about ETFs, exchange-traded funds. We talk about mutual funds. I find that a lot of people buy stocks specifically, and they don't have a criteria why they're really buying them, meaning they buy them with little research. They buy things maybe they've heard of, they believe they understand, but ultimately what happens to too many investors is once they buy these, again, they often don't know when to sell. And stocks aren't the only problem. Mutual funds are the same thing, bonds, ETFs, all investments may need to be sold at some time or reduced position. I want to pull up this particular stock. This is Exelon, and this is a great graph. I received a lot of calls on Exelon because a lot of people look for the high dividends that a lot of these utility companies pay. And as you can clearly see from this graph, Exelon is falling quite a bit, actually about 25 to 30% in value. That red line is the 200-day moving average. One of the things I talk about a lot on my TV and on my radio shows about using these moving averages. Exelon is, again, another case where it gave you a clear, decisive sell signal. I remember getting a call one time from somebody on my radio show. He actually owned a few $1 million, about $2.5 million of Exelon. And the first problem that I had with this large position is I told him, it's more than 5% of your portfolio. Never, ever own more than 5% of any one individual stock. If you do, you're taking far too much risk. Well, this person worked for Exelon. He accumulated a lot of stock, and it represented about 95% of his portfolio. And he thought he knew Exelon really well. He thought he knew more about Exelon than anybody else, and of course, he liked the nice dividend. What happened after that call, he said, you know what, I know it's starting to drop, but it'll come back because it's Exelon. That stock always stays stable. I tell investors any stock can drop and any stock can go out of business. I don't care what company it is. I urged him to reduce his holdings down to 5%. Of course, I don't think he listened to me on my radio show, but I believe he's a sorry investor today. When he called my show, Exelon was actually about a $70 stock a few years back. That stock today is around $35. Exelon's dropped over half its value, folks. And of course, that stock may never come back to $70, and it could drop further. By the way, recently, Exelon just cut its stock at the beginning, or cut its dividend at the beginning of this year. This is a problem that investors face. You get enamored with the stock or any investment, it goes down in value, you don't want to sell because you're going to wait for it to come back up. Has that ever happened to you? And believe me, a lot of investments don't ever come back. That's why you need to have a decisive investment strategy that includes risk management and when to sell. I want to go to my next chart here. This is Bank of America. This is kind of the same thing, folks. You can see how this has fallen off a cliff. Bank of America was a $45, $50 stock back in 2007. Of course, it dropped to about $4 and change. Imagine if you held that to the bottom. My next caller, Bill from Punta Gorda. What do you think about variable annuities? Bill, I get a lot of calls about annuities in general, whether they're fixed or variable. I don't like them. Bottom line is annuities are sold by so-called advisors or annuity salespeople or brokers. That's it. Annuities have high expenses, mediocre investments. They lock your money up sometimes between 5 and 20 years with a surrender penalty. The average variable annuity that I've reviewed, and let me tell you, I've seen thousands of these come through my front door over 27 years managing portfolios, and I'm yet to find one of these broker-sold annuities that are of quality for your portfolio. The average variable annuity that I review has an expense ratio between about 3 and 5%, is pretty typical. Imagine if your expense ratio on your annuity is 4%, Bill. That's coming off the top of your return. Most of the sub-accounts or the investments, Bill, inside these variable annuities are often mediocre. So you couple mediocre investments with high expenses, and again, who's managing this portfolio? Who's picking the allocation? Who's making the changes? I can pretty much guarantee you Mr. Broker who sold you that annuity is probably not going to call you a whole bunch or give you any further recommendations after he makes that juicy commission. Now, I don't have a problem with somebody necessarily making a commission, but when it comes at the brunt and the problems for retirees, annuities are sold products. Keep away from them. High expenses, mediocre investments. Tell me one thing, you don't have an investment strategy, and I believe those are going to hurt your retirement portfolio. Annuities are sold, they're not bought, and people hear about these guarantees that, in my personal opinion, these excessive fees do not outweigh the guarantee that this insurance company is giving you. Before you put your money into your hard-earned dollars into an annuity product, folks, get a specimen policy, read the fine print. After you've done your research, if at that point you determine something that's highly expensive with mediocre investments is good for your account, fine. But do your homework. Don't let somebody sell you the next annuity product without being an informed consumer. Folks, we're getting close to out of time. I don't have a lot more time for calls. I want to kind of wrap up a little bit. Again, economy's getting a little bit better. Stock market's done pretty darn well. Large cap emerging market are basically lagging small cap emerging market. One of the things that we do on a routine basis within our strategy is we rank what's called relative strength. I want to leave you with this. Relatively stronger investments trending up historically have outperformed over certain time frames. Relatively weaker investments going down have underperformed over certain time frames. You're better off to buy investments towards a 52-week high than buying 52-week lows. Relative strength, we like it. I want you to learn more about it. You can come to our upcoming workshop. I'm just about out of time. Make sure you have your safe and profitable week and call our office for a consultation. There is a difference. We invite you to experience it.